Deep Dive, MercadoLibre, MELI, Full Valuation Case and Monte Carlo Simulation by Value and Momentum Portfolio. Institutional-grade research on MercadoLibre with catalysts to watch and actionable insights for investing. Company Overview. MercadoLibre, headquartered in Montevideo, Uruguay, is a premier online commerce and fintech ecosystem in Latin America. Founded in 1999, the company operates across 18 countries, including major markets like Brazil, Mexico, and Argentina. Its primary platform, MercadoLibre Marketplace, allows buyers and sellers to engage in transactions through a user-friendly platform accessible via mobile apps and websites. The company generates significant revenue through third-party sellers, while also offering direct sales in selected categories to enhance competitiveness. Mercado Pago, its fintech arm, offers a comprehensive suite of financial services, including digital payments, credit, and investment products. This platform is rapidly expanding, with services such as prepaid and credit cards, point-of-sale solutions, and digital wallets, fostering financial inclusion in a region where traditional banking services are limited. MercadoLibre's logistics network, Mercado Envios, is a pivotal part of its value proposition, facilitating efficient shipping solutions across Latin America. The company's advertising platform, Mercado Ads, provides targeted advertising opportunities for sellers and brands, leveraging extensive consumer data. With a robust presence in the region, MercadoLibre is a key player in the digital transformation of commerce and financial services, aiming to enhance access to e-commerce, digital payments, and financial solutions for millions of Latin Americans. Moat analysis. To understand MELI, you have to stop thinking of them as an e-commerce company. They are a closed-loop ecosystem. Imagine a five-sided fortress. You have the marketplace, Mercado Pago for payments, Envios for logistics, Ads for visibility, and MELI Plus for loyalty. When a user touches all five, they become what the company calls an ecosystemic user. At that point, they aren't just customers, they are effectively locked in. A seller lists an item on the marketplace, ships it through MELI's planes, gets paid via Pago, takes out a business loan from MELI's lending arm, and reinvests that money into Mercado Ads. Every layer adds a new cost to switching. Amazon took 15 years to build this in the US. MELI has successfully replicated it across 18 different countries. The real secret sauce here is first-party data. MELI knows everything: what you buy, how often you pay, and, crucially, if you default. Because they see behavioral data that traditional banks can't, they can underwrite loans for the unbanked population with surgical precision. And they are scaling this with serious tech. As of late 2025, 95% of their staff uses Gen AI, and nearly a third of their production code is AI-assisted. They aren't just moving boxes, they are a high-velocity data machine. Then there's the physical reality. Mercado Envios. This is a massive network of aircraft, fulfillment centers, and last-mile vans. A competitor can build a website in a weekend, but they can't build a decade's worth of logistics infrastructure overnight. Combine that with Mercado Pago, which is often a consumer's very first interaction with the financial world, their first savings account or credit card. In Latin America, being the first mover in trust is a compounding asset. In a region historically wary of fraud, the MELI brand has become the gold standard for security. But no fortress is impregnable. The biggest immediate threat is Amazon. In March 2026, Amazon launched Amazon Now in Brazil, offering 15-minute grocery delivery. That was a shot Steiner across the bow. Amazon has the AWS cash flow to subsidize losses and the logistics to challenge MELI in its biggest market. If Amazon decides to squeeze margins in Brazil, MELI will be forced into a very expensive defensive crouch. It's not just Amazon. Asian giants like Shopee, Temu, and Shine are flooding the zone with ultra-low-cost, direct-from-manufacturer goods. MELI can't match those China-sourced prices without gutting its own margins. Fundamentals and business performance. MercadoLibre is currently caught in a classic tug-of-war narrative. On the surface, the company remains a dominant powerhouse, maintaining an impressive lead in Latin America, with top-line revenue growth holding strong between 35% and 45% year over year. However, the market is no longer giving them a free pass on growth alone. Investors are now laser-focused on the cracks appearing in the bottom line. The real concern is earnings quality. Despite that massive revenue, earnings per share have missed expectations in 4 of the last 5 quarters. The fourth quarter of 2025 really drove this home, showing a 12.5% decline in EPS, the first meaningful contraction we've seen in quite some time. It's a clear signal that margins are compressing. Essentially, even though the company is bringing in more money, it's becoming significantly more expensive for them to actually generate those profits. If we look at the core profitability metrics, the erosion is visible. Net margins dropped sharply from 10.5% down to 6.4% year over year, and return on equity followed suit, falling from 14.7% to 8.3%. This profit squeeze, combined with a debt load that nearly doubled in 2025, climbing from $5.7 billion to $9.2 billion, definitely warrants our attention. The valuation has already started to reflect this shift, with the PE ratio compressing from 78 times down to 49 times. But it's not all red flags. The company still generated a massive $4.2 billion in free cash flow in the final quarter of 2025. The big picture for listeners is this: MercadoLibre is still growing fast, but the market is transitionary. It's shifting from valuing the company on pure scale to questioning how much of that scale actually reaches the bottom line. Quality of earnings review. Let's talk about the numbers under the hood. All 3 of MELI's margin lines are currently compressing. Now, usually that's a red flag, but management was very transparent on the recent call. They confirmed that 5 to 6 percentage points of that margin hit is coming from deliberate investment. They aren't losing money by accident. They are spending it on purpose to widen their moat. From an earnings quality perspective, that's actually a positive sign. It's a choice, not a surprise. However, there is a more concerning trend we need to watch: the return on invested capital, ROIC. In 2024, MELI was seeing returns between 5% and 7.5%. In 2025, that plummeted to between 2.4% and 3.6%. Here's why that matters. We estimate their cost of capital, WACC, is somewhere between 13% and 15%. When you factor in U.S. interest rates and the inherent risk of operating in Brazil and Mexico, you simply cannot justify a cost of capital below 10%. There is a massive gap here. MELI is currently earning about 10 to 11 percentage points less than what it costs them to raise money. In pure economic terms, the business is currently losing value on the capital it invests. Management's defense? They say this is front-loading. They are pouring money into free shipping and credit cards today, betting they'll be profitable tomorrow. They pointed to their Brazilian credit card business as proof, noting it turns a profit once a customer stays for 2 years. The risk for us as investors is the clock. If Amazon's pressure forces MELI to keep spending indefinitely, that return on capital may never catch up to its cost. To fund this expansion, MELI has taken on significant leverage. Their total debt has surged 4.2 times in just 6 quarters. They've moved from being a company flush with cash to one that is modestly in debt. Most of this is being used to fund their lending book and meet regulatory requirements for banking licenses. While it's structurally explainable, it's a real weight on the business. Their Altman Z-score, a measure of financial health, has slipped from 5.3 down to 3.5. They are still in the safe zone, which is anything above 3.0, but the downward trend is a definite yellow flag. Finally, let's look at how they are driving revenue. While revenue grew a healthy 39%, their credit portfolio nearly doubled to $12.5 billion. Think about that. Their lending is growing 2.3 times faster than their sales. On the surface, the loans look healthy. Credit card defaults are at a record low of 4.4%. But if we look closer at the end of 2025, we see lag risk starting to creep in. Delinquencies ticked up in Q4, a time when seasonality usually makes people more likely to pay on time. Management says they are intentionally moving into higher risk, higher reward lending, but if the economy cools or if Amazon squeezes the merchants who owe MELI money, those losses could hit the balance sheet very suddenly. Analyst coverage. The consensus on Wall Street is still firmly bullish, with the vast majority of analysts holding buyer overweight ratings on the stock. However, if you look under the hood, price targets have been steadily cut across the board since late 2025. The most recent and notable shift came just a few days ago on March 12, 2026, when JP Morgan downgraded the stock to a hold. They cut their price target to $2,100, specifically citing the rising competition in Brazil following the Amazon Now launch and the resulting pressure on margins. It is a meaningful signal because JP Morgan had been one of the last major holdouts to lower their expectations. Right now, the average price target cluster sits between $2,400 and $2,700, which is still well above where the stock is currently trading. Even with that optimism, JP Morgan and Jefferies are now the only two firms sitting at a hold. It is clear that Amazon's entry into the Brazilian market is a specific catalyst that is starting to weigh heavily on investor sentiment. Valuation exercise. When you look at the valuation, it's clear the market is currently pricing MercadoLibre at a bear case level. It's trading at a multiple more in line with its lower growth peers, essentially betting that margins will stay squeezed and that the competitive landscape is going to permanently cap any earnings recovery. However, if you look at the sum of the parts valuation or a standard discounted cash flow model, both suggest the stock is actually substantially undervalued. That is, of course, assuming the current heavy investment cycle eventually pays off and margins can climb back toward that 18% to 20% range. The real tension right now is that we are sitting almost exactly at that bear case valuation. This means there isn't much of a safety net if things get worse, but there is massive upside potential if we see a turnaround in the margin story. Moving forward, the single most important variable for us to track is the EBITDA margin trajectory over the next 2 to 3 quarters. That's going to be the ultimate signal for whether the market moves toward a recovery or stays stuck in this cautious cycle. Monte Carlo results. To wrap up the technical side of the valuation, we ran a Monte Carlo simulation, basically stress testing the stock by simulating 1,000 different future paths. We looked at 4 key variables: revenue growth, peak margins, the cost of capital, and the long-term terminal growth rate. The results from this simulation are pretty unambiguous. Even when accounting for a wide range of outcomes, the expected value for the stock comes out to approximately $4,060. Compared to the current price of $1,728, that represents a massive potential return of about 135% if these underlying assumptions hold up. Now, it's important to note that the standard deviation here is quite large, over $2,000, which just reflects the genuine uncertainty that comes with investing in emerging markets. But the most striking takeaway is the asymmetry. The math is heavily skewed to the upside. 80% of all simulated outcomes landed above the current stock price. Meanwhile, the downside seems to be firmly anchored by that bear case floor we discussed earlier, between $1,400 and $1,626. Essentially, the risk-to-reward ratio here looks incredibly skewed in favor of the patient investor. What could change the thesis? The biggest immediate threat is the recent escalation from Amazon. On March 3, 2026, Amazon launched Amazon Now in Brazil, which was the primary catalyst for the recent JP Morgan downgrade. The danger here isn't just about groceries, it's about a potential price war. If Amazon aggressively subsidizes shipping to win market share, MercadoLibre may be forced to lower its own free shipping thresholds. This could turn their current shipping investments into a permanent, ruinous cost rather than a temporary competitive edge. This leads directly into the margin story. Management has been very open about the fact that margins are currently under significant pressure, about 5 to 6 percentage points, due to investments in shipping, credit expansion, and cross-border trade. They've signaled that these are investment cycle pressures that should eventually ease. However, if competition forces these subsidies to stay in place indefinitely, we won't see that recovery toward 18% or 20% by 2027. If those margins don't bounce back, the bear case effectively becomes the new reality. We also have to look at the credit book, which nearly doubled this year to $12.5 billion. While credit card defaults are currently at an all-time low of 4.4%, we are seeing a slight tick-up in early-stage delinquencies. When you combine this with the company's $9.2 billion in corporate debt, the business is now much more sensitive to the macro environment. A sudden interest rate spike or a recession in Brazil could turn a growth engine into a liability very quickly. What are the upside catalysts to watch? The single most important date on the calendar is May 7th, 2026. This will be our first real look at the new shipping cost structure implemented back in January. If this move to de-average pricing based on dimensions and weight successfully reduces the margin drag, the market will likely re-rate the stock immediately. Even a modest recovery of 100 to 200 basis points in EBITDA margins could trigger a sharp rally simply because current sentiment is so negative. Bottom line, so what's the ultimate takeaway from MercadoLibre? The big question is whether this margin squeeze is just a temporary phase of heavy investment or a permanent scar from Amazon's push into Brazil. Right now, the market is pricing the stock at its absolute bear case floor of about $1,626. It's essentially betting that margins will never recover and that Amazon is an existential threat. However, the data suggests a different story. Our Monte Carlo simulation shows that 80% of possible outcomes lead to a higher price than what we see today, and a sum of the parts, look at the business, shows the stock is roughly 37% undervalued based on its peers. Almost every major analyst still has a buy rating, with an average price target of $2,458. The real moment of truth comes in May with Q1 earnings. If we see even a slight improvement in margins, something management hinted at after restructuring their shipping costs in January, this valuation gap could close very quickly. From a trading perspective, the $1,650 to $1,750 range is our primary entry zone. At the current price of $1,734, you're sitting right on top of fundamental support. The upside potential here is massive compared to the risk. If we hit the first target of $2,100, which is JP Morgan's conservative target, you're looking at a 23.5% gain. If the base case plays out over the next few years and we head toward $4,053, that's a 135% return. From a $1,700 entry, the math is heavily skewed in your favor. It's not a safe or low volatility trade, but the reward for being right far outweighs the cost of being wrong. Disclaimer: this report is prepared for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation of an offer to buy any security.